Good evening. Welcome with Business at 9 with all the buzzing stories from the world of business here domestically and globally. I'm Vikram Oza on ET Now, wishing you a great Dussehra tomorrow. And as we bring in the festivities, we're watching what the markets have done today. The bears definitely have taken charge of the Indian markets with the Nifty down 1.3%. And this is the biggest single session decline we've seen in a span of 7 months. So clearly the Nifty is nervous. It's also hit its 1 month low. It's ended below 19,300 today. And all the components of the index have declined in today's trade, barring Mahindra & Mahindra and Bajaj Finance. The Sensex as well has lost 800 points in trade, and all the sectors have ended in the red, with PSU banking emerging as the top drag as far as the benchmarks are concerned. And if you look at the broader markets, the Midcap index has slipped below the 50-day moving average. It's happened for the first time in a span of 6 months. So what happened when the Midcap index slipped below that 50-day moving average back in the year 2006? That's what we've tried to analyze. And my colleague Ansh is coming away with the results of our research. Ansh, do make that comparison for us. How did the Midcap index do in 2006 compared to what we're seeing it do now?
Yes, right. So Nifty Midcap Index has slipped below 50-day moving average for the first time in over 6 months. Now this is a noteworthy occurrence because the last time when Nifty Midcap Index broke below 50-day moving average after sustaining above this moving average for 6 months was 17 years back in the year 2006, between 14 November 2005 and 16 April 2006. Following the breakdown in 2006, within a month, the Nifty Midcap Index fell by approximately 30%, whereas the Nifty saw a drop of 28% during the same period. But what's interesting is the reversal that happened after this crash. After the crash, Nifty Midcap Index rallied by an impressive 190 to 200% to touch its record high over the course of a year and a half. Whereas Nifty Index also saw a substantial rally of about 140 to 150% to touch 6,400 for the first time at that level. So history suggests that the correction of 2006 in the market had given a good opportunity to investors to accumulate good stocks at cheap level. Now whether a similar trend will repeat or not, only future sessions can give us some idea about it. So keep an eye on Nifty Midcap Index.
We'll definitely be watching the Midcap Index and what it does from here. But overall, the markets have seen this decline and there is a sense of nervousness among investors. The global bond market, we're seeing the US bond yields surge. So how is that going to impact the Indian markets? In fact, a discussion was on today here in these very studios. The managing editor of ET Now, Nikunj Dalmia, was in conversation. Here's an excerpt.
See, what happens typically is that you must realize that we live in an AI-dominated world by algorithms. Now, these algorithms are programmed around 200 DMA. These algorithms are programmed around bond yields which are at pivot points. So like I was saying that when 2 became 3 in the uptick post-COVID, we saw some selling by FIs that time. When 3 became 4, we saw similar kind of a phenomenon. 4 has become 5. See, bear in mind that the bond yields had become almost sub 1% at the peak of COVID. 1.5, 0.75 becoming 5, that's like a 400% jump. And that will lead to financial adjustment in the near term. And then beyond a point, FIs, they continue to sell. DIs will also say, okay, what's next for us? So I think this what's next question is something which in a sense is also having an impact on selling. But I think it's a bull market correction. By the time we'll realize that it's savage and swift, it'll be over.
Well, there is a bull market correction is what Nikunj sees it as. Let's ask what Manish Singh makes of this. He's joining us on the phone line from London. Manish is the Chief Investment Officer over at Crossbridge Capital. Manish, good to have you with us. Ever since the Middle East crisis broke out, and I've been speaking to market experts through that period, almost everyone I've spoken to, Manish, has given that as a rider, that Indian markets will move on with its bull phase, provided the war doesn't escalate. Well, it has, and worries over the price of crude oil are growing. You agree that these two are the prime factors why the Nifty is nervous now, or do you see other areas of concern as well that could possibly make the Nifty slide further?
I would agree with you, Vikram, and also from what your colleague Nikunj mentioned about how the algos trade, I think those are the key things to watch out for. Now, if you look at the price action today on US 10-year yield, which had gone to 5% and now it's at 4.88. You had a headline where Bill Ackman said that he has closed his short on US Treasury. Now, by all imagination and anything that we are saying, we are trading at peak rates. We saw Fed Chair Chairman Powell speak last week, and he didn't say much. He couldn't say much because there's not much to say really from where things are, and we are definitely at peak rates. So if you bear that in mind, that we are at peak rates, we have seen a rate increase of record number and both in terms of Fed and bond yield, then I don't see where the bearishness in equity is going to come from.
Right.
And if it is there, then it has to go away because what is the path from ahead from here?
Correct.
Rate cut or yield normalization.
Right.
So I think that's what one has to bear in mind from long-only traders. Yeah.
But Manish, a couple of months ago, you favored parking investments in American debt. Do you hold that view even as we see these American bond yields rise to 16-year highs?
I would say that, we do mostly equities, but yields probably are going to stay elevated. So for the same reason that, I was not invested in fixed income and bonds for a long time, and then we went into some of the fixed income investment because the yields were attractive. Now, I don't see that yields are going to go back to the low levels that we saw in the past, which, with the benefit of hindsight, was a policy mistake. The Fed is going to fight that. Yields don't go back to those levels. But even if yields were to go down to, let's say, on 10-year basis to 4, you're going to have long duration benefit, right? So if you're holding a 20-year bond, you're going to make on the upside 10, maybe even 20 points, from where things are. So one has to understand that with the bond market, it's about duration and convexity. And now you have positive convexity on the long end of the curve.
Right.
So a 50 basis point decrease in yield on a 30-year bond can make you 10 points, whereas 50 basis point increase will lose you only 1 point. So I think bond, you will see more money coming into bond, which is why you're seeing TLT, which is a 20-year plus ETF, is still getting money despite that ETF being down 51% from its all-time high.
Yes. We'll keep tracking the markets, Manish, and appreciate you joining us with your perspective each time. Thank you very much for joining us tonight here on this edition of Business at 9. Thank you.